Hello, everyone, and thank you for joining me. My name is Dr. Amani Palmer, and I will be presenting on how cyber insurance companies determine cyber risk. Before we begin, I want to state I am new to the cyber insurance game. Before I began to work in this industry, I received my PhD in computer science from the University of Illinois. Shortly after my graduation, I worked as a research scientist for the Information Trust Institute. I then moved to work as a data scientist for the Bank of America. Most recently, and my most relevant move, is to my role as a data scientist for Corvus Insurance. Corvus Insurance is an emerging company that builds products to help drive data-driven underwriting. We will begin with a discussion on what exactly is cyber insurance, the history of it, and what does the current cyber insurance market look like. The rest of the presentation will follow the ways cyber risk is calculated, the future of these calculations, as well as its challenges. There is an infamous quote: "There are only two types of companies, those that have been hacked and those that will be." However, while being in the cyber insurance game, I tend to prefer this quote: "There are only two types of companies, those that know they have been hacked and those that do not." This is the basis for companies to purchase cyber insurance. Cyber insurance is an insurance product intended to protect businesses by providing services to protect them from risks relating to information technology infrastructure, information privacy, information governance liability, and other related activities. The coverage provided by cyber insurance policies may include data destruction, extortion, theft, hacking, as well as denial of service attacks. Organizations buy cyber insurance for many reasons. In general, they buy because data breaches are costly, cyber incidents happen a lot, coverage works, cyber insurance companies are happy customers, uninsured companies believe they are secure, and is deemed a necessary part of risk management. My favorite part is the uninsured believe they are secure. This usually means that when they are hacked, they run to grab cyber insurance quickly after. The history of cyber insurance begins in 1997 with the first written cyber risk policy, combined later with the Y2K as a catalyst for organizations to focus on technology risk. From 1999 to 2002, the dot-com bubble only increases this initial phase of technological risk concern. In the early 2000s, the California Security Breach Information Act required organizations to notify all affected individuals if personal information was reasonably believed to have been accessed by an unauthorized person. Many states added similar laws, increasing the need for cyber insurance coverage as well as expanding the types of coverage. In the mid-2000s, the number of breaches are on the rise. Cyber insurance coverage expands for various organizations and now includes business interruption, extortion, and network asset damage. The late 2000s is marred by heterogeneity. Each cyber risk carrier had different views on cyber risks and different views on what are important cyber issues. In the 2010s, the number of carriers has grown, as well as the number of breaches. The products are now evolving, and carriers are changing appetites in response to breaches. In the present day, the pricing of cyber risk coverage is volatile. Coverage terms still differ greatly, and there is movement towards providing risk management services with the policy. The current U.S. cyber insurance marketplace has reached an interesting crossroads. Cyber insurers have been enjoying a profitable run for several years, but are now facing a changed risk landscape with data breaches, ransomware attacks, insurance claims, and overall threat awareness increasing. The profitability of the cyber insurance has been strong, but concerns are continuously emerging. Claims are growing exponentially, which will be an issue if prices cannot keep up with rising frequency. Carriers are needing to provide clients with a transparent risk calculation model in order to provide greater clarity in their insurance contracts to set transparent expectations for themselves and their clients. So let's discuss how this cyber risk is being calculated. Cyber risk calculations is the application of risk calculation techniques on an organization's cyber posture. The process includes first evaluating the cyber risk and then validating, measuring, and analyzing the available cyber data using mathematical techniques to accurately represent the organization's cyber environment in a manner that can be used to make information cybersecurity infrastructure investment and risk transfer decisions. The methods are divided into two main categories, qualitative and quantitative. Qualitative methods typically rely on an ordinal and, in other words, rating of 1 to 10. There is also the relative scales, stating high, medium, and low to rate risk based on expert opinion. However, relying on the qualitative method solely on its own has many downsides. Executives cannot use qualitative risk assessment to determine how much risk-based capital to hold in a rainy day fund. The lack of consistency of these methods makes it very difficult to truly understand an organization's risk, as well as to detail true high-risk entities. On our left, we have an example of the ordinal risk matrix, and on the right, we have an example of the relative risk matrix. Quantitative methods attempt to describe how problem space works by identifying the key elements that make up the environment and the relationships between those elements. If the models are relatively accurate, once again, no models are perfect, then analysis performed using the model should consistently align with our experience and observations. With those elements identified, measurements can be made that enable risk quantification and performance of what-if analysis. Examples of quantitative methods include high impact-based risk management, Bayesian methods for risk assessment, and as well as some form of machine learning algorithms. The impact-based risk model relies on calculating the probability of impact known cyber risk on an organization's infrastructure. This risk model assesses risk with one equation. Risk equals consequence times likelihood. Likelihood is the probability of occurrence of an impact that affects the environment, and the consequence is the environment impact if an event occurs. The impact-based risk model combines the scores from the qualitative ratings and generates a risk score. The higher the probability of a worse effect occurring, the greater the level of risk. However, this method suffers from oversimplification, as well as the fallacy that risk is independent. Bayesian methods for risk assessment rely on Bayesian networks in order to capture the interdependencies among risk factors, as well as combine data with expert judgment. Bayesian networks hold a graphical structure that are used to represent knowledge about a certain uncertain domain. While Bayesian networks are visual descriptions of the interdependencies between risks, they rely on Bayes' theorem to compute the probabilities in the model. Bayes' theorem is written as the probability of event A occurring, given that event B has occurred, is equal to the probability of event A occurring multiplied by the probability of event B occurring, given that event A has occurred, divided by the probability of event B occurring. On our left, we can see a Bayesian method for depicting if the chances of, based on if it's cloudy, if a sprinkler has come or if it has rained, and therefore that means we have wet grass. On the right, we can see Bayes' theorem broken down. We have our posterior probability, which is equal to the likelihood times by a prior probability divided by our marginalization. This diagram is an example of Bayesian analysis applied to the base case risk levels for data leakage, assuming different levels of control, effectiveness, and corresponding interactions. The Bayesian model is marred by two major challenges: staying up to date with the ever-changing cyber landscape, as well as pulling in enough data to calculate these probabilities. We can use various machine learning algorithms to help us in our overall goal, the assessment of cyber risks. We can use machine learning algorithms for threat intelligence, forecasting, and modeling. With the cyber threat landscape growing, the quantification of cyber risk is constantly changing. It's time to expand our efforts in this area towards risk-related decision-making, risk sensing, and automation of risk processes. Risk-related decision-making is the analysis of large volumes of contextual data and decision points to determine rational choices, thus helping insurers make strategic and financial decisions that align with the organization's risk appetite. Risk sensing, or prediction, is identifying and predicting risks that are difficult for humans and rule-based systems to spot, such as new categories of risks, diffuse risk signals, and potential sources of future risks. Automation of risk processes lead to the automation of labor-intensive, error-prone, complex risk processes that deal with high volumes of structured and unstructured data, especially processes that could benefit from a tool that self-learns over time. I believe the future is to combine the analyst-driven solutions with probabilistic machine learning approaches into what is known as analyst tuition-driven solutions. Insurers will rely on data in order to build their risk score. This will be accomplished by relying on unsupervised learning to extract meaningful patterns from the data as a form of risk prediction. These patterns will be ranked by confidence and shown to a cybersecurity subject matter expert. This subject matter expert will provide insight into the provided patterns. These features will be added to a supervised learning model and create a useful model used by the insurers as an enhanced version of risk-based decision-making. The insurers will provide necessary data back into the unsupervised learning model in order for constant tuning of the model to grow with the landscape of cyber and overall automation of risk processes. The future of cyber risk quantification is essential to the growth of cyber insurance market. We need to begin moving forward and developing more skills and talent in this area. Thank you all for joining me. My email address is posted, and I'm happy to discuss this further in my off hours. Once again, thank you for your time, and I'm happy to answer any questions.
Amani, welcome. Thank you for your terrific talk. Lots of great questions coming in. So we're going to dive right into the first one. You just gave us the how on cyber insurance. So why is this taking off? Why is cyber insurance taking off?
So I think the biggest reason is with a lot of the press and publicity of a lot of data breaches, especially over time, a lot of smaller companies are realizing they're also at risk, and same with medium-sized companies. So I think it used to be, the larger companies knew that they needed protected, but the biggest deal being that now these smaller and medium-sized companies are getting into it, and so that means the market has just ballooned like crazy.
Great. So the next one we have is, have you found that different types of data or different data sources tend toward being better indicators of specific kinds of risk during your research?
I would say most definitely. I think what is somewhat funny about it is the fact that it's not always what maybe I think as a cybersecurity person we would think it is. Like, oh, they don't have email authentication turned on, so this is a big risk. I think a lot of it so far has been, industry sector. So education might be a big problem. If you're a school or something, I think local municipalities could be a big problem. It sort of seems like it's the idea from the attackers who they want to attack, and we're sort of getting that characterization through some of our claims data and some of the people we've been talking to. So it's been an interesting I guess, repetitious figuring out of features, where we might make some assumptions and then we go back and maybe we're being proven wrong, right? I would say so far, I think it has opened up my mind as like maybe somewhat in the red pen tester area of like, oh, this is maybe more of how we think for sure.
Okay, next from James asking, any issues with scaling Bayesian models?
So the main problem that we and possibly would be dealing with that is in terms of dealing with the uncertainty of each types of municipality, size of industry class, number of people in a company. So I think the scaling in itself and the general idea wasn't the big deal. It was more of in terms of how do we best understand each different model we need to build for certain classes. So scaling in itself wasn't a big a deal. It's more of a, we don't want to overscale. So how do we break down our clients into subcategories, and then dealing with those subcategories, how do we have to better change our model for each one of them?
Great. Thank you for that answer. Nest, what are some of the challenges you have found when determining risk in a data-driven manner?
Mainly, I think what everybody else has found, which is that data collection and handling structured and unstructured data for sure. We're getting data from multiple sources and from multiple different tools, and there's not a beautiful way of bringing them together. And then I think on top of that, in the risk market, we're not just looking at cybersecurity tools. We're looking at our clients in general and possibly, web hosting companies they're using, any managed service providers they're also using, trying to better determine what is risk in this day and age and for each type of client we have.
Great. So we got two more questions in the queue for Amani. So if you have any questions, feel free to get them in there now. We get a question from Josh Amani asking, how are the standards and metrics for these models going to be evaluated? Are government policies needed for direction?
That is a very, very good question. I think it's a fair understanding that, right, it's sort of similar to health insurance and other things. You don't want to sort of demonize somebody or a client for being who they are, right? If you're a local municipality, you don't want to have an insanely higher quote rating just because you are a local municipality. You could have better security than others, but you might be demonized just because of that. To be honest, those standards I think will definitely be needed. I think maybe government direction would always be helpful to make sure things are being regulated. Right now, I think the market is just so open and crazy that they can sort of scout for whoever you want. So if somebody's sort of demonizing you for this structure of your infrastructure, definitely, go out, seek another quote, seek another advice from other people and get that information. I think the biggest concern is if we turn to bigger monopolies, then there'd probably be some government oversight so that people aren't being demonized for their internal structure.
Great. Thank you for that. Last one in the queue for you here, Monty, but a little bit longer question. So if you need me to repeat, feel free to chime in with that as well. So you said the impact measurement suffers from being a bit oversimplified. How do you get buy-in from risk assessors on more complex models as you trade off easy comprehensibility and the calculation for more reliability?
Okay, I think I got most of that. So I think the first question is impact being oversimplified and sort of how do we help understand that and maybe pass this off to assessors and clients as well. And I think the first answer is trying to be as open and as granular as possible with your reporting and with your system. So to avoid saying, because you have email authentication not avoiding. You want to sort of say like you lost points because you don't have email authentication turned in. That's something you want to tell them and be honest about. Or you lost points because you have 30,000 ports open. If you have 5 ports open, you would be fine, or in this range of ports, then it's okay, but this is enough. So trying to be as granular about the features you're using in these black box models and having that ML explanation, which I think is somewhat of an up and coming field where you have a better idea of what you're doing with these black boxes so you can help explain what needs to go in to improve scores for your clients. I think there was a second question, but I definitely forgot it by now.
Yeah. And actually, we had another question come in that's great. So let's move on to that one. So you're not quite off the hot seat yet. So we'd like to get this one. This question is, how diverse are the approaches from different cyber insurance providers? Are different companies taking common approaches, or are they looking at this differently?
So I will say maybe from an overall view, I think, a lot of people are using a data-driven method. But after that, I think it becomes very diverse on what does data-driven mean. It doesn't necessarily mean machine learning. It doesn't necessarily mean Bayesian modeling or statistics or even probability. Some of them maybe are still using a very qualitative method in terms of risk assessments, which is just determining asking, a bunch of cybersecurity people, hey, how do you feel about this? And getting a general response back. I think that covers the gamut in terms of the approaches. And then even on a granular level, deciding that, telnet port should always be closed or not. That is the types of features that different people have varying different approaches and for varying different reasons.
Great, Amani. Thank you for your presentation. Thanks for handling all these questions. I hope to see you on Discord